Ok. Fermín, regresamos a la Luis. Es más rico hablando de los reales. Hay que terminar con esto.
Let's finish up the last two sections we have, describe accounting for lessees by lessors. So now we're moving to the other side of the equation for the accounting. We've already learned how to do all the accounting if you're the lessee. Now let's discuss the three methods if you are a lessor. So as a lessor, the benefits is that interest revenue. So you're getting paid interest revenue, there's tax incentives, and you have a high residual value on the actual asset. So a lessor determines the amount of the rental based on the rate of return, which is the implicit rate needed to justify the leasing asset. So what this basically is saying is, I have a piece of equipment. I calculate how much I want to make by leasing it. So if I say I want to make an implicit rate of 10%, I want to make 10% on top of what the value is of this asset. That's to justify. If a residual value is involved, whether guaranteed or not, the company would not have to recover as much from the lease payments. So these are the three types of classifications by lessor. So if you recall, on the lessee side, we had capital and operating. Here we have three. We have operating, direct financing leases, and sales type leases. So these two are going to be one of the two categories. If it's neither of these two, it automatically reverts to operating leases. So just like on the lessee side, where it said if it's not a capital lease, it automatically becomes an operating lease. Here is the same situation, and we're going to go into more detail with direct financing lease versus sales type lease. But basically, the easiest way to remember this is in the name, direct financing leases. So you're pretty much directly financing it for the lessee. I have a piece of equipment and I'm financing it on your behalf, and you're using the equipment. Sales type lease means that there's a profit, and we'll go into more detail now. So, classification criteria. So if you recall on lessee, we only had these four, and you had to meet one of the requirements of these four in order for it to be capital. In this case, on the lessor side, it's two criteria. One of these and both of these in order for it to be a sales type lease. A sales type or a direct financing. So one of these and two of these. These four are the exact same ones as the lessee, which is the transfer of ownership, the bargain option or bargain purchase option, the 75% or more of the estimated economic life, or the present value of the minimum lease payments exceeding 90% or more. Group 2, collectability of the payments required from the lessee is reasonably predictable, meaning that you have more than a 50% chance that you're going to be collecting the payments. And no important uncertainties surround the amount of unreimbursable costs yet to be incurred by the lessor. So again, it basically means that you have to make sure you're collecting your lease payments. So if it meets one of these and two of these, then you have a sales type or a direct financing. If not, it becomes operating. Same slide as the lessee, where it goes through the questions. If you continue answering them, these, if it's no, it becomes operating. If it comes over here where it has a yes, it's sales type or direct financing.
I'm just saying direct financing is easy to operate.
Second.
The direct financing is easy.
Operating is easy.
Operating is
correct. So direct financing and sales type are going to be the ones that are similar to capital. Okay. So we're going to start off with direct financing. Direct financing, in substance, the financing of an asset purchased by the lessee. The lessor records a receivable, a lease receivable, instead of a lease asset, and the receivable is the present value of the minimum lease payments. So if we book it, when we were doing the lessee, if you recall, the liability was the present value of the minimum lease payments, and we would record the asset. So this is just backwards. Now I go on the other side. So back to our problem. And I think they did add something new to this. Let me just make sure. 5 years, 25, 2,100, initial direct costs, negotiating, a renewal, it reverts back, collective. Okay, so in this case, the only additional information it gives you is this one. Collectability is reasonably assured and Caterpillar incurs no additional cost. Why do they give you this information? Because remember in group 2, you need to meet that criteria. That's why they're telling you this. Okay? So you have to meet one of group 1 and the 2 of group 2. So we start off with the computation of the lease payment. So what basically they're doing is they're taking the fair value of your lease equipment of 100,000. In our example here, there is no residual value, but if there were, we need to calculate the present value of the residual value. So the amount to be recovered by the lessor through lease payments is $100,000.
Esta no es como la semana de